Hello, this is Chuck Cornwell. I'm the Chuck in the Markets Up Chuck. And, today's blog was titled When the Price is Right. And, there's a couple of different messages I'm kind of putting out here. One is that even during recessions, there are companies that can do extremely well. But the most important message I'm putting out today is the idea that, very fast-growing companies are actually worth more than slower-growing companies. And sometimes a higher price-earnings ratio is not actually a more expensive stock. For example, you look at Priceline during the last 8 years, I want you to notice they've had an incredible growth rate of over 65%. They've gone right through this recession with really terrific operating results. Their earnings grew, 48% in 2008, and they're expected to grow 65+% this year and over 20% next year. Even though the stock trades at 27 times earnings, which is higher than the general market, because of the huge growth potential this company has and how fast it has grown, it theoretically could be on sale. But you need to do your own homework to determine that. I'm just showing you what the chart shows. It is trading at a price-earnings ratio that's significantly less than it historically has. The blue line shows it's normally traded at around 37 times earnings. But look at the track record this company's generated with no debt on the balance sheet and all this growth. A $100,000 investment in this company in 12/31/2002 would have grown to $2,299,000. That's a 57% compounded rate of return versus only 3.4% in the S&P 500. And I want to point out that's very, as I always do, very consistent with the rate of change of earnings growth of 65%. It's a little less because the company on a historical basis is a little undervalued. The company did fall during the recession, but look how quickly it's recovered. It got down to under 40, just around $45 a share in 2008, and since then it's rallied back up to $220 a share. In the long run, earnings determine market price, and the value of a company relates very strongly to how fast that company can grow earnings. This is Chuck Cornwell, so thanks for listening.